If you give to charity and you're entering retirement, there may be a smarter way to plan your giving and your taxes at the same time. Instead of writing checks every year, a donor advised fund may allow you to make a larger charitable contribution in one tax year, receive the benefit today, and then recommend those grants in the future to your favorite charities over time. Hi, I'm Todd Gurno at Three Creeks Capital. We help families think through the decisions that affect retirement income, taxes, investment, and legacy planning. Today, we're going to break down what a donor advised fund is, when it may make sense for you, and how it can be a very powerful tax planning tool for the right people. So let's start with the basics. A donor advised fund is a way for you to give money today and then give the money away to the charity at some point in the future. It doesn't have to be right away. So the old way is we used to write checks to charities and take the donation off of our tax return. And a lot of that changed when people went from itemized deductions to standard deductions. And that just meant they can no longer get value on their tax return for giving that money via check. And so they came up with these donor advised funds as a way to give money or appreciated stock to the fund and then eventually give it to charity. So here's how it works. As you can see here, the donor, which is you, gives cash or appreciated stock. So think of your mutual funds, individual stock, ETF, whatever it may be that's appreciated in value. Keep in mind that's got to be in your after-tax non-qualified account. You give that to your fund, your donor advised fund that you set up. So you put cash in there or appreciated stock. And I'll get into the tax planning piece later in the video. But you can see here, you're the donor on the left, then you're giving that to your donor advised fund. And if it's appreciated stock, which you'll see in a minute, it can be extremely valuable. Why? Because not only are you giving away the stock itself, the shares, again, mutual funds, ETFs included, but you're not selling it first. So you're not taking the capital gain, then getting the donation. You're just sliding it right over there, not taking the capital gain, but getting the donation. So now it sits in this fund. You can see right in the middle in the green. It can continue to grow. So you never sold the shares of the company, the mutual fund, or the ETF. It continues to grow. And then you say one day, well, you know what? I'm going to start giving some of this money away. And that's where you can see that final piece on the right you give to charities. Now keep in mind that tax deduction, the donation that happens today, you get the value of that today on your tax return, even though in the future you may give away the money. You can leave a beneficiary on this, and that beneficiary can then also give away that money on your behalf. So we set this up for clients that have a lot of appreciated stock, but first and foremost, you must be charitably inclined, because when you put money in your donor advised fund, you cannot take it back out for your benefit. It needs to go to a charity. So keep that in mind. Next, I want to cover some tax planning tips here where you can actually see the value of making these donations. I'm going to show you next. Okay, let's get into the tax planning aspect, the value, and why you would consider doing a donor advised fund. So let's say, for instance, you're working, and you can see that I have scenarios built here, 24 tax year, 25, and 26. So you can see across the top, we've got wages, and eventually we retire in 2026. So very common for a lot of clients. Then we have some interest, let's say off your bank account, some dividends off that after-tax account that I talked about earlier. And then maybe you're old enough, you have a little bit of pension income coming in. So we can see in this case, we have a pretty large or substantial non-qualified account if it's producing not only a fair amount of dividends, but also some capital gains. And those capital gains may not be the buy or sell of something. It could simply be capital gains that are pushed out from a mutual fund or something that you have. So in this particular case, then we can see in my example, we have some self-employed income, some business income, and we're trying to determine for the client, hey, what is their best route? What's their best tax scenario? They're charitably inclined. How do we do this in a way that benefits them and the charities? And so what you can see here is we've gone through, we can see they're in an itemized situation. And so what we do here is we determine how much, based on their income, they can move over in appreciated stock or mutual funds to their donor advised fund and take that deduction on their taxes. So as you can see in 2024, what I had recommended and what they took was about $104,000. Now in this particular case, we can see here that for 2025, we were recommending about $94,000. Well, why does it go down so much in 2026? Our recommendation's only 63, call it 64,000. And that's really built around your income. So keep in mind that you are capped at your donation amount based on a percentage of your overall income. So as your income falls, you may be able to do less into your donor advised fund and get the full deduction that calendar year. Now keep in mind, as I've shared here in 2025, we had a carry forward of about 2,000. So in this particular case, let's say in 2026, you may take that 63.7, but you say, well, I really want to put 100,000 in my donor advised fund. Not a problem. Still do the 100,000. What you would do is then just carry forward that remaining 37, call it 40 grand into next year. So you do carry forward any unused charitable contributions to your donor advised fund. So again, another very powerful tax planning tool. And let me show you why. So in this particular case, we're going to move appreciated stock, let's say in 2025 or 26, doesn't matter. And we can see ultimately what our tax bill is here. So our total tax was about $30,000. Now that's with this donor advised fund of 93. So what if we made that a 0 here and see what happened to our overall income? So our tax bill, now that that is zeroed out, we can come down here and see, oh, by the way, instead of owing 30,000, I now owe 49,000. So again, we didn't sell anything. We just simply moved over shares into our donor advised fund. So we didn't pay capital gains tax, and we got the donation, in this case, about 95, call it 93,000 in total. We had to carry forward that other 2, if you recall. So that helped him out by almost $20,000 and paying 20,000 less tax. They're already charitably inclined. Great move. Great idea for this particular person. Consider a donor advised fund. Again, these are very complicated, sophisticated tax planning tools. If you can't figure this out on your own, feel free to give us a call. We'll help you think through what you need to do here. The most important takeaway is that a lot of times, instead of giving these smaller amounts via a check, there's ways for you to give this in bigger, let's say, donations, using appreciated stock and getting more value out of it today, okay? So if you're already giving to a cause you care about, the question becomes, is there a more tax efficient way to do it? I hope this video was helpful. Please like it and subscribe to the channel. We're creating videos to help families make smarter decisions around retirement, taxes, investment, and long-term planning. For more resources, visit threecreekscapital.com, and you can also book an intro call by following the link in the video description. And if you're thinking about taxes and retirement, watch this next video, Why Retirees Should Consider Roth Conversions. Thank you.